Hi, everyone. Welcome back to another episode of For What It's Worth. Myself, Ben Hager, Jeff Hedley. All right, Jeff, we're back for another month. I figured what we do is kind of focus on a couple of big comments here and then dial into some more particular areas of focus on your side. So one thing I want to start with is, as January goes, there's a saying that as January goes, so goes the year. We're off to a pretty decent start so far this year, right? I don't know if that tells the whole story or not, but it's something to keep in our minds that history has shown that if we start off with a good pace for the year, tends to put us in a pretty good spot as the year goes.
Ben, we look at statistics all day long, right? And history for whatever it is worth, no pun intended. The first year of a presidential election term, rarely do you have a negative year. You have a lot of volatility, and this year seems to be a lot more than normal, but you generally have a good year. It's that second year that you got to really be concerned about.
For sure. And speaking of data points, Jeff, I mean, that's a good comment on some of my next points. And again, I'm really just trying to set the stage here for how are we thinking about markets today, right? So some of the data points, look back to 1980. There's only been 2 years since 1980 that we have not realized a 5% or greater drop in the market during the calendar year.
Yeah.
Only 2.
Yep.
So this is normal, right? It's very normal to have 2 to 3 5% type variety drops. That was kind of in line with last year, even though last year felt pretty calm. Mm-hmm. And then every 12 to 18 months, we should experience something in that 10% plus type variety. The 20s come further stretched out, more like on the 3-year type time horizon. But I looked back and it's been since October of 2023 since we experienced a 10% correction.
Yeah, so we've had a really good run in the market, extremely good run in the market.
And that's, I think, really the main point that I wanted to bring up is, look, we've gone through an extended period of subdued volatility. And part of that is preparing ourselves for the thought that, look, when it shows up, even a 5% drop is going to feel kind of extreme because we haven't had it, right? And we all know that they're normal, but, even sometimes when we see on any given day, the size of a drop of the Dow, it's like 600 points, 700 points. In the media, the nightly news is going to want to, sensationalize that like it's this huge thing. I mean, one, we got to remember how large the market is these days, and is that all that big, but also understand that that's the normal part of business, and we plan for that to happen. And we build portfolios, build everyone's financial plan accordingly. We understand that's got to be a part of the deal.
And we have been very, very clear, in our conversations, with clients since the last part of last year and going into this year that, listen, we have to prepare ourselves for a larger market correction within the next 2 years. I always say that if we don't see that happen, I get more worried than if we do. And market corrections don't happen because everything is going great. So I think that, again, yes, we've had a very good run in the market. Yes, we're seeing some volatility now. Yes, we're probably going to see some additional volatility with a larger correction. But again, we're not seeing anything that would tell us that something bigger is lurking at this point. But there are data points that we follow and we watch very carefully, which are some of the things we're going to talk about today.
Yeah. And last thing I'd say, and then we're going to dig into some of those finer points, is, look, we've never really been through a point of history, and you could even go back to 2008, and we've had this extended time period of really nice market conditions. Mm-hmm. But throughout all of this, actually, I heard someone say this, probably a year or two ago, and I thought it was very appropriate. There's never been a more hated market that has consistently gone up than what we've experienced the last 15 years. And that's what I would say about today. You do not go through time periods in history where asset prices are going up, whether it's business valuations, your stock portfolio, your home value. We don't go through periods in history without quite a bit of hand wringing along the way. And I think this is another episode of that. So, with that comes a lot of noise. And I think that's where, to your point, what you're going to get into here, Jeff, is we need to focus on some finer data points. So maybe share with us, what are those finer data points we're using to help us tune out some of the noise today?
Yeah, and I want to be clear. I mean, the data points we're looking at are different than the macro issues that we've been talking about, right? The debt,
Mm-hmm.
um, inflation, although that is one, and Mag 7 stocks. We've talked about that. Those are big picture items. What we
Mm-hmm.
really look at on the day-to-day economic data coming out that really becomes important is, really a couple of things. Inflation and interest rates is one, earnings from corporations, and then economic growth and the stability that we're seeing within the market. And those are the three things I'd like to kind of drill into a little bit very quickly today and talk about those and what we're seeing. And with the acknowledgement that, right now we are in a heightened period of volatility. Things are changing very quickly. Let's not run away from that. Let's acknowledge it. So the things we are going to talk about, they're changing. And, we're getting data that is choppy right now.
Yep.
And
Mm-hmm.
again, we're looking for longer trends, what we're seeing, not a month to month print. So, let's just kind of dive in real fast. Inflation, interest rates, core inflation right now. Recent reading is 3.3% as the end of January. Remember, the Fed's target is 2%. We have maintained all along it was going to be very, very hard to achieve, a 2% inflation rate. And, it is proving to be sticky. At the end of last year, we were at the 2.7, 2.8. So, we're starting to see a little bit drift upwards in inflation. Not anything at this point that, has got us increasingly alarmed. But, that is something that, again, we're watching very closely. Currently interest rates, we had a spike in rates, shortly after the election. They jumped pretty quickly. After about 45 days, we had almost a 1% increase, but they've settled down. And, right now, 10-year Treasury is kind of range bound between the 4.3, 4.6 range. That's something that we watch very carefully in terms of, how the capital markets are looking, at our economy, our debt, things like that, debt issuance, capital drawdown. But we are right now and have been really since probably mid-December, really kind of range bound there. March is coming. There is going to be a lot of volatility in March. Tariffs, we're not sure whether they're going to be enacted or not. Congress is beginning to debate the debt ceiling and the budget reconciliation. It's important to understand we hit that debt ceiling in January. It hasn't been changed. We've been living off savings. The government's been spending down, their general account. That's another issue that we're looking at. We're getting to the point where, you spend it down so far, you got to have a cushion, just like, an individual or a
Mm-hmm.
corporation. And a lot of that's going to come into fruition in March. So as of right now, inflation's sticky. We're kind of hovering in that 3% range. Treasuries right now, kind of range bound in that 4.3, 4.6 area. But again, March is going to bring some interesting things that we'll see probably happening on the interest rate side. Wrapping up fourth quarter, we're almost done with all fourth quarter earnings. They were strong. Actually, the fourth quarter was the strongest quarter of earnings growth we've had since, post-COVID rebound. With that, though, for the second week in a row, we're seeing some earnings, revision downward, and some of that's
Mm-hmm.
extended out into the third quarter. And, not that that's abnormal when you're coming off a period where you've had really strong growth. Also, companies, because they're experiencing a lot of the same uncertainty that, all of us are right now with a lot of stuff that's going on, questions are surrounding, are they padding some of those revisions downward? They'd rather
Yeah.
obviously, revise them downward and then have a pleasant surprise. The market would
Kind
like
of
to see
hedging a little bit, right?
absolutely they're hedging. So Again, this is something that we got to take with a grain of salt, but it is something we have to acknowledge. And again,
Mm-hmm.
I think that is reflected in some of the economic growth that we're seeing and just the stability out there. We went into this year, we knew going into this year that GDP was going to come down. I mean, estimates are for about 2% this year, coming off of, a 3.5% print last year. Um, Again, some of this is normal when you're in a later economic cycle.
Mm-hmm.
So from that standpoint, that is being backed up with some of the data that we have that's coming in. People are still calling for a soft landing, not a recession at this point, but a soft landing. And I think that is also partly what we're seeing with the Federal Reserve, where, they're also being a little bit more cautious here in terms of, what they are doing in terms of, cutting interest rates. But things can come out, external shocks, the uncertainty, it can hit it. That's part of the volatility again that we're seeing, but we really need to kind of see some trends developing. And those are things that we're just going to watch on a month to month basis. I mean, again, we're going to see
And,
some choppiness.
and I think it's important just to acknowledge, I mean, we went through some pretty long runs through the kind of the early 2010s. I remember some economists calling our economy the plow horse economy. I think
Hmm.
that says it all. I mean, that is not a recipe of we can't succeed and grow, right?
Correct.
Is that
Absolutely.
fair?
Very fair. Very fair. And, again, have to acknowledge things come in cycles, just
Mm-hmm.
like the market comes in cycles. I mean, rarely do we go 3 years without a, 20% correction. You're not going to go 3 years of solid economic growth. It's just high prints. At some point it slows down a little bit, and that's what we're seeing. We expected that going into this year, and it will be reflected into obviously the market. I mean, most people are saying, mm, single digits this year, not
Mm-hmm.
20% returns like the last couple of years. Uh,
Right.
but I also think that, quite frankly, it's going to be a slugfest,
Mm-hmm.
and you need to be present to be able to get those returns, this year. So,
Absolutely. Absolutely. And I think this is, we say this in every conversation we have with folks, but I think it's really important right now with all the information swirling out there. Don't sit on it. I mean, one, something you bring up might be something that we want to address, on a talk like this, because I always remind myself, if someone else is thinking it, if I'm thinking it, there's other people in company with me. So if you're thinking it, there's probably other folks that are curious about it as well. So share what's on your mind, share your thoughts. One, it could be a topic of conversation for us to have here with a broader group, but then individually, this is a time that we want to make sure those concerns are addressed, and let us know if there's things weighing on your mind, because there is just a lot of information right now out there.
yeah, and it's changing very quickly. And I think that, it's important for, our clients to understand that we spend an awful lot of time diving into these economic numbers on a weekly and a monthly basis, looking at what the trends are of them, looking at the geopolitics of the world, and understanding that we are in a heightened volatility right now. Lots of things are changing quickly,
Mm-hmm.
which means that things can also change down and up very
Yep.
quickly. So
Yep.
just kind of, take a breather. We're following this stuff. We need to make changes. We'll make changes.
Absolutely. Absolutely. So with that, I think we'll wrap up here and leave it on that last comment. But Jeff, before we part ways, just want to make sure, any last comments from your side?
Again, it's the volatility. I mean, everyone has just got to, I think, take a step back and understand we are going to have a lot of volatility for this first 6 months of this year.
Mm-hmm.
There are a lot of things that are being tackled. The administration is trying to tackle, and we just got to be prepared that it's going to be choppy, and and keep that in the back of your mind.
Absolutely. Absolutely. All right. We'll leave it there. Jeff, thanks for all the thoughts and insight, for sharing with us here today. And we look forward to talking with you all again here next month on a planning topic. And then we'll be back here in a couple months for an investment update in the meantime. Look forward to talking with you all again here soon.
Everyone stay safe.
Bye now.
Bye-bye.